Okay, folks, welcome back. This is the weekend commentary and lecture for the ICT Mentorship for March 21st, 2021. I'm going to do a very light general commentary, and then I'm going to go right into the lecture and focus on the scalping setups. All right, so we have our daily chart here, and I'm going to preface it by saying that I'm not 100% confident because we're doing weekend commentary and I don't know how we're going to open on Sunday. So take that with a grain of salt, but I will tell you what I think may transpire or what I'm personally looking for. All right, so we have volume imbalances up in here that have had wicks trade through them. When we have wicks trading through them more than once, I'll classify that as a fair value gap. Initially, it would be a volume imbalance on this candle here. Then when it trades back up into it there, it becomes a fair value gap by classification. That's the way I describe it. That's how I log it, and that's how I view it. Same thing here. Okay. So we have the breaker in here, the low, the high, the lower low. Prices moved ahead and one above it, touched the imbalance up here, came back down, and was unable to come down any deeper into this order block. So we traded into this low and just a little bit below it, and then on Thursday it rejected that. Friday, I would have liked to seen Friday close a little bit higher than that. I don't like the idea of it coming up and coming off the high that much, but we'll see what we get. It looks to me as if we might still want to go higher. So I'm going to go with that expectation going into the week and look for things to support that idea. I don't know for certain it's going to do that, but in my analysis on Monday, I want to see what has transpired on Sunday's opening and how it traded into midnight on Monday. And then on New York session Monday, I'll determine whether or not if what I'm saying here still holds true, that being a modest bullishness to the dollar. If we take out this low, then it makes perfect sense for it to come back down in here. This is what I was looking for initially on the midweek review. It came down on Thursday just to run higher, and we've been basically inside this consolidation, which is a little frustrating if you're a swing trader or a position trader. But I've been focusing your attention on intraday scalping because of this very profile. So when the markets are in small little ranges like that, you're either forced with the decision of taking scalps or sitting on your hands. The alternative is going in here trying to take trades and losing. So I'm building the idea that this breaker is supporting this price action, and we're probably going to run up into this imbalance that is now labeled as a fair value gap, which was previously a volume imbalance. All right, the hourly chart on the dollar. We have a fair value gap up in here. The buy side liquidity I mentioned on Thursday's daily log entry, that was beautifully delivered too. And we still have a little bit of imbalance in here. I don't like this much of a receding from that high, but we'll see what we get going into Sunday. I like the fact that we've taken out this low here 2 times, and I like how it was done with it was a lower low than that, and then it ran one more time, then ran away. So I like that. I like the fact that it completely overtaken this imbalance. It didn't just come up here, fill the imbalance, and go lower. That's what everybody thinks. Everybody looks at charts and they see this thing here and they say, oh yeah, it goes up here, it's going to close it in and go down. Wrong. Wrong. You have to know what you're doing. You have to know what the underlying context is. And while it could have done that, I sided with on Thursday telling you that I believe it's going to go up here. I believe it's going to take that buy side liquidity out, and don't just think of it here. It could do that, and that would make me wrong on Thursday's daily log entry. But it ran to the buy side liquidity like I was looking for. That run into that on Friday set up the stage for me doing executions in Eurodollar. And the outline I gave you at the 8-minute mark or so on Thursday's daily log entry, I outline exactly what cable did. No one can say that's hindsight. No one can say that's luck. Okay, I gave you the logic behind it. I told you what it would likely do. And because it was a Friday, that's the profile I would go with. And it was to script. So I have people in the Telegram channel that I created. And yes, it is absolutely a huge distraction. But I'm doing this because I'm giving of myself even more, because I'm getting people feeding me intel about you guys in here that are abusing my generosity. So because I'm helping them, they're helping me, and I'm weeding out the individuals here. So if you're leaking or if you're selling, I guarantee you you're going to be caught and you're going to be surprised, but it is what it is. But I'm getting folks sending me messages that everything I'm doing is hindsight. And you all know the inside. Like, you know what I'm doing when I call these moves. When I give you the logic behind it, I'm not just saying it's going to go there. And of course, anybody can do that. No, not anybody can just go in there and do what I'm giving you. What I specifically outlined for cable for Friday. Nobody is doing that. Not one person out there, not any one of these yahoos that are running their supposed mentorships, IML guys, and you all know who you are in here. You can't do that unless I say it and you parrot me. That's experience. That's real intel. That's real insight. That's the real mechanics of how this market delivers price. And it's, to me, very entertaining when they're sending me a DM and they say it's all hindsight. And it's not hindsight. It's foresight. And then I'm acting on the things that I talk about with you in public executions. Like, you all don't see private executions in here. Everything I share is done publicly. But you all know the logic as to why I'm going in that direction. But they think it's me recording multiple things and then showing the things that work. So in this lesson tonight, I'm going to give you some details as to what I'm doing in that Telegram channel. Okay? I'm not using Enigma. I'm not going to do it because I don't want to make those examples available for study. But the folks that are watching me there, they're gobsmacked, because even though they're small little 10-pip ranges and I'm reading it like a book I've read 50 times, it exhilarates them and it motivates them. And some of you that are mentorship students that are in there are saying the same thing. Like, man, this is crazy. Like, you're able to see that because I'm executing in TradingView. I'm outlining it. I'm showing you where it should go, where it should not go, where it's going to go to next, and then it delivers. Now, I've said this all along, that I could have been doing this all this entire time since the first time I stepped out on baby pips. But that's not what I wanted to present initially. I wanted to see who was interested in really learning how to do it, not just watch me do magic tricks, okay? I want to see the folks that want to learn how to do this and then have to submit to the process that is required to learn how to do it. Tonight's lesson and lecture is going to specifically deal with the multitude of opportunities that's available, the various ways that I see the market and how I frame trades, and if I miss specific entry points, how I can still get in those moves and target levels that I teach you intimately here. With great deal of detail you learn here, I'm going to break down the euro and show you exactly how, when I was watching price today, what I saw. I wasn't just looking at it and seeing OTEs. I wasn't looking at it and just seeing breakers. I'm showing you exactly how my mind looks at price, and I match up things. And then I determine, is this a viable trade for me? Is this something worth me getting into? And what would be the framework for that trade, and where would the risk be in taking it? And then how should it deliver? And how many times it does this? And how many trades are offered on a 1-minute chart? Once you see this, you're going to be like, wow, there really is a lot of setups that you aren't noticing right now. But when you watch me do examples of executions, and people say it all the time, like, I don't know how he's getting these entries. I don't know how he's getting these entries. I'm going to show you some of that tonight. And it's not Enigma. Okay, so don't think it's Enigma. Don't go out here pretending you know how to do Enigma, because people are going to tell me about it and I'm going to correct you openly. Okay, there's some people out there that are already trying to say, oh yeah, the IMP24 node. You don't even know what that is. So stop talking. I wish I never even brought it up, to be honest with you, but it was my way of saying, look, there's something that's out there that if people know what I know, they would know what that is, and they don't. So there's your litmus test with me. If you think you know what I know, then you'll know what that is. And no, it's not in the chart. So anyway, I'm thinking that we're likely to get up into this fair value gap and run this buy side liquidity here. So I want to see, does it offer me scalps? Because I'm still in scalping mode. I'm not in a swing trader mode. I'm not in one shot, one kill mode. Like, I'm in really close to the vest. 10, 15, 20 at best. That type of mentality for intraday scalps, because the market's just been really weird. They've been manipulating price a lot in the last 2 weeks. It's been so manipulated. It's obvious that they're doing something and they're preparing for something big. And what I mean by that is they're going to have a lot of volatility enter the marketplace. And right now, there isn't enough sentiment on one side of the marketplace to offset that or upset it. So while we're waiting for them to create something, and maybe FOMC was that thing and they're just going to work towards building on that sentiment next week. Maybe it's just too premature for me to see it because we went into Friday. But I'm thinking that we're likely to see some pretty decent moves coming up, because we've been in really small ranges on the daily chart. And small ranges on the daily chart tend to beget large ranges. Large ranges is where trading gets really, really easy. It's just like, that's the salad days of trading. Salad days is an expression where it's just like, that's what you want. You want it really easy. It just falls in your lap for you. And if you can learn to wait for those environments and trade only those instances in price action, then you'll find that trading is very easy and very stress-free. Okay, not without risk, but right now you have to be nimble. And I've had members email me, and they're all in the first group, emailing me saying, I messed up, I destroyed my account, I thought I was going to be able to do what I could do, and I was overconfident, and I did this and I did that. I've had dozens of them from the first group already email me saying they were dashed on the rocks this week. Now, let me remind you, I stated, do not trade with live funds while you're going through the mentorship, because you're going to watch something and you're going to get a false sense of security. You're going to get overconfident thinking you know something because you watched something by me and think you understand it because you watched it one time. That's foolishness. And I also stated there's two ways to learn. You learn by inspiration, or you learn through pain. And the dozens of you that learned this week by not listening to me, by not taking the advice I gave you, you have blown your account. Now, most of you that have emailed me have owned that responsibility, because I didn't put you in any of those trades, especially the things that you're trading with yen. I don't touch yen. Some of you did not say it was my fault, but you didn't take full ownership of it either. That's a problem, because you have to own it. You messed up. You did not listen. And you're emailing me, and I said I did not want to see these types of emails because you have been warned not to do these things. And now here you are. You have learned through pain. Needless pain. Now you have that toxic thinking that I was trying to avoid from you experiencing this pain. So now you're going to be second guessing everything in the future because you did not listen. And as a mentor, that's extremely frustrating, because I go at great lengths, at the risk of boring the people that know this, to warn you not to do it. But now you have the scars. Congratulations. You're just like me. And I have to fight through that stuff still to this day. I think about things I used to do and I get enticed. Well, I did that one time before. No, That's outside the rules. Don't do it. So now you understand pain and now fear. Everything going forward now is going to be measured with a huge measure of, what if this happens again to me? Do you see what you've done? You have created a barrier that would have otherwise not been there. And it's going to be harder for you as a result. It's not impossible, but you're going to have to overcome a great deal of adversity internally because of what you did to yourself. And that's what I was trying to avoid. So if some of you are in here have not had that experience yet, and you're still dabbling with live funds while you're still trying to learn how to be a trader, stop. Do not do what these folks in the first group just reported to me. Nobody in here was told to trade anything, but they're out here doing it, and they're learning the hard way. That's foolish. Don't do that. That's how I screwed up. I was doing things I wasn't supposed to be doing with live funds before I even knew what I was doing. None of you know what you're doing. None of you know what you're doing, period. First group, you have no idea what you're doing. And you watch something I'm talking about, do not think that you know that thing I'm teaching. You're just being introduced to it. And I don't care how good I am at pointing at things, you can still screw it up. If I'm pointing to where I think the market's going to go, oh yeah, it's going to be easy. I'm going to sell short because he said it's there. And then guess what? You get in there and they run on your stop because you didn't enter at the right place. Or you tread your stop too tight. You lose, you get back in, and then it wipes you out. Or you didn't use a stop. Then it does a FOMC type event. I can't put duct tape on your hands to prevent you from going in and pushing the execution button. I can't do that. The only thing I can do is talk to you like I do. I'm trying to prevent you from hurting yourself before you give yourself a real chance to learn this. I can't remove you from all the dangers. I can just inspire you not to do those things. And if you don't listen, you learn through pain. So now you've endured it. Learn from it. Don't do it again. So anyway, I know some of you don't need to hear that, but it's just good medicine. All right, so if we get up to this fair value gap in here and trade above it, that could offer some support as well, and maybe work up into this larger imbalance on the daily chart. If we break below here, then obviously everything I mentioned on the daily chart would be back in terms of probability. Right now, my focus is bullish. All right, euro-dollar daily chart. So we do have this sell side imbalance, buy side inefficiency still up here, but I'm focusing primarily on this dealing range, these highs, that low. That's all I care about going into the beginning of this week. Which side of the marketplace is this thing going to go for? Because ultimately, right now, it's 50-50 either way. It could just break and go lower, or it can go right back up here and run those out and then go lower. I don't know right now. You hear that? I don't know. There's going to be times where I just don't know. And looking at this, I don't know. But what I would like to see is how we start trading on Sunday. And if Monday gives me an opportunity where it gives me a very clear indication it wants to run for this low, then I'll scalp it and I'll short it. But if it opens gaps higher, trades down, fills the gap, and runs into London an overnight Monday going into New York, then I'm going to probe this area here for a buy to run the buy side liquidity out. Just scalping. That's all I'm going to do. I have no idea right now how to play this market any longer term than scalping, because the probabilities are equal on both sides of the marketplace as it is right now. Shocking, huh? ICT, come on. You should know better than that. No, I don't. Right now, I don't. So, learn from that. Euro dollar, 1 hour chart. All right, so here is the nitty gritty and the basis of what I was working with on Friday when I was doing that scalp. We have the buy side imbalance, sell side inefficiency from FOMC. And all of this was apparently a short-term fluff. And it came back down. Came right back up into the buy side imbalance, sell side inefficiency, consequent encroachment. That's the midpoint of this range high to that range low. 50%, extend it through. It trades right to that level. Okay. When it hits that level, and we're going to look more detailed at that high and how we broke down. But this right here is just a beautiful return back to a logical level that I teach you that is based on algorithmic principles, not anything else. Yes, there's optimal trade entry there, but the main point is it's going back to this midpoint here. That's a PD array. What type of PD array is it? It's a premium array. Premium array is institutional resistance. Real resistance. Not implied, not hypothetical, not a hope it is. It's real institutional resistance. So we're anticipating that market to hit that level and then show this type of response, attacking this relative equal lows here, and then we have a fair value gap in here and this old low as well. So if we roll over, okay, if we roll over and we start to trade through into this fair value gap, I think eventually we're going to make an attempt to get below this low. But for now, this is enough to frame a trade. It's not a lot of pips, but I'll work with that on Monday if it's giving me that inkling. Otherwise, I think it's hard for it to get up here and run back up higher for this fair value gap. Given the current market environment, it could do it, but it's just not likely to do it based on what I see. And what really builds that opinion I'm holding is that we ran this high all through here. And with all of this, we've not been able to hold it at all. And we went back below this low here. So that kind of looks a little suspect to me. And it just means that it's more likely, not absolute, it's more likely that it's going to roll over to the downside. So if I had a gun to my head, okay, which side am I trying to pick for euro? Lower. It's the opposite as outlined on the dollar, okay? Not plan A, not plan B. I'm telling you what side I'm wanting. But just bear in mind that it's Sunday opening and I have no idea what it's going to do. All right, British pound versus US dollar. Daily chart, same thing. This dealing range high, dealing range low. I'm favoring a move to the downside, closing in the remaining portion of this buy side imbalance, sell side inefficiency, which would also take out this sell side liquidity here and rebalance all of this. I'm favoring a downside move, running out liquidity. Can it get up in here? Yes. Is it likely based on what I see right now? No. But if I'm wrong, then I'm wrong. Okay. I own it. Okay. But I'm looking at the same thing I've outlined for euro dollar. These are the two areas, this high and this low. That's what I want. Which one's going to run out first? Is it going to be the low or is it going to come back up to the high? If it comes back up to the high, then it needs to get there and reject and go lower. But the fact that we've been back and forth in here, which either one gives up the ghost first, in other words, which one breaks first, this one or that one, sets the tone whether we go here or here. Because we've been in this range for a while now. So I don't anticipate it going through this low and then back up and keep going higher. I'm thinking it's going to go through this to go here. I'm thinking if it goes above here, it's going to go into here, and then after that, I don't know. Like I'm not looking beyond this fair value gap and this fair value gap. So if it breaks the high here, it's going into that fair value gap. If it breaks the low here, it's going into that buy side imbalance, sell side inefficiency. But I'm going to scalp it if it gives me the opportunity to, and you'll see in a couple minutes how many opportunities it gives when it's there. This low sell side liquidity or buy side liquidity above here. Basically keeping it very close to my vest. So we have the hourly chart here, and bearish order block here, trades up into that, breaks down, and we have the breaker, which is these 2 consecutive down close candles, makes up our 60-minute or 1 hour bearish breaker. The premium high on that breaker is here, and the discount low is here. Extending out in time. We're inside that now. So I'd like to see it just stay heavy and roll over, attack this low and this low, and then get over here and attack these relative equal lows over here. That's what I want to see. That's the gun to my head. What do I think is going to happen? I just told you. So I want to try to look for shorts on cable with that mindset. All right. Like that? It's like George Lucas did that for me. Special effects. How about that? I'm sparing no expense for you all. You should be appreciative of that. I'm just kidding. Anyway, we are looking at the euro dollar. This is a 1-minute chart. I know some of you are freaking out like, I don't want to look at a 1-minute chart. It's going to teach you how to read the tape. It's going to teach you how to read price. It's going to help you understand what I'm doing intraday. And even if I'm showing you a chart with a 15-minute time frame or a 5-minute chart, I am, without you knowing it, I'm looking at 1-minute chart order flow. And this is what I'm looking for. Okay. And as a reminder, folks, this is not Enigma. Okay. It is not Enigma. I'm not going to teach Enigma. I'm not even going to get close to hinting at it. It's just me teaching you deeper price delivery. That's it. Okay. So the market's trading up into that buy side imbalance, sell side inefficiency, consequent encroachment that was formed on the FOMC rally earlier in the week. So when that formed, that midpoint that I said we would look at when we got into this portion of the teaching, this is the lecture portion, by the way. When the market hits that, that's a premium array. That's what we anticipate as institutional resistance. It's occurring during the London Open Kill Zone. Now, for clarity, with the daylight savings time in New York applied, UTC -4, the beginning of it for London Open Kill Zone is 2 a.m. New York local time during daylight savings time, and ends at 6 a.m. New York local time during daylight savings time. So that's your London Open Kill Zone, and the market trades right up into it, trades into the buy side imbalance, sell side inefficiency, consequent encroachment, some random level, some highly specific level that I've been teaching you for years now. We have the high here, the low, and that higher high as it hits the buy side imbalance, sell side inefficiency, consequent encroachment. Once it hits that, then and only then we watch to see if we break down. We break that low right there. That becomes a breaker. Incidentally, let's just toss this out there. It's been brought to my attention that there's a company out there called Guerrilla Trading. Not gorilla like the animal, but like gorilla like a guerrilla soldier. You know, like, well, military guerrilla. And they're teaching what they call is the bullet pattern. And it's just this pattern. It's the breaker. And, you know, they got all these people going the FTMO challenge or whatever. And I'm really annoyed right now. And it's just been brought to my attention today. So I'm going to dig into that a little bit. But their bullet pattern that just come out of nowhere with it a little while ago is nothing more than my ICT breaker pattern. This is going to feel like what they teach. Okay? And if you're new and if you've been familiar with that, it's going to sound like I ripped that off. But I've been teaching the breaker for a long time, much longer than they came out with it. Okay. The logic of what makes my breaker a breaker is what I'm showing you right here. The only thing they'll say, and anybody else that says, they teach it like it's a break and retest. Okay. I can show you lots of failures of that logic of something breaking and coming back up and it runs right on through it. I can show you lots of examples. In fact, it might be a good exercise for you to go through sometime on a Sunday when you have some free time instead of watching football and sports. or golf. How anybody watches golf? I don't get it. But nonetheless, take that time and go through the charts and look for failed break and retest. Okay, that would be something like this. Forget this buy side imbalance, sell side inefficiency, consequent encouragement. Forget that levels being there. If you're just looking for naked price action and you're looking for all these higher lows and then finally a low gets broken and it comes back up, look for instances where that fails. And you're going to be surprised how often that fails if you're looking for it. But if you go in with the logic that I teach you, like this level here, that is real resistance. So it invites the context to unfold and then a narrative to develop. And what does that mean? As we hit this level, it should break down. It should. So where's it going to break down first? Where's the low prior to that run up? Right there. And here's the high prior to it hitting that. So any buy stops that were above here, for anyone that was selling short early on, they get broken. That's the breaker. They get broken. Then price breaks through that low. When that happens, then we have the breaker, because this level is key, not because we broke this low. Then price has a change in the state of delivery. What does that mean? It was offering buy side. Now it's keyed up with looking for sell side delivery. It's wanting to go lower. When it trades there and hits the breaker, then I'm looking for, okay, right now the narrative is underway that it's going to reach for sell side liquidity. My mind goes into seek and destroy. Where are the sell stops? So right away, you have this low, which essentially was equally traded to, if not went below. I can't tell. Mine aren't as good as they were when I was 20. But we'll just say not that one yet. We're going to look for this one. There's sell side liquidity below that, below that, below that, here and here. And ultimately the low that was formed before the FOMC run up, which is here. Okay. This area right there, when we were trading at 119.35, that's that 119.35. So this chart here on the 15-minute time frame is exactly at that moment right there. These two wicks in here, that's these two highs right there. So I'm looking at this buy side imbalance, sell side inefficiency, midpoint, extended in time, bam, hitting it right there. This is what it looks like on a 1-minute chart right there. And this is the breaker that's broken to the downside, comes back up. There's where you start looking for the change in the state of delivery for price. It's going to start offering lower price. It's not guerrilla trading. If you're paying attention, listen. It's not selling pressure. It's not sellers driving the market lower. That's not what's going on. There's a change in the state of delivery where now the algorithm is going to start offering price lower and lower and lower and lower. And that's why people eventually get squeezed out of their positions. It's not, oh, we're going to keep sending price up because of buyers and we're going to squeeze them out of their trades. That's not what's going on, folks. That's not what is going on at all. Who's in control of price? This is the euro dollar. Bank of Germany. The Central Bank of Germany is telling us what the price is going to be. It doesn't matter how many people are buying or selling. It is what it is. And you're either going to pay the price they're going to give you or you're not. Okay? I mean, that's just the way it is. That's the game. But this low here is this low right there. See that? 118.91 and 2 pipettes. 118.91 and 2 pipettes. So if we're going to be from here and attacking that low there, that's what I'm thinking when we're trading there. Then I'm confirmed there. That now there's a change in the state of delivery. Euro dollar is going to start pricing lower. I don't care how many people come in and buy it. It does not matter. It does not matter. They can buy a lot of it right there. And as it goes lower, oh, it's cheaper. Let me buy more of it. And it's still going to keep going down. No matter how many contracts or lots that people go in and buy, it doesn't matter. They're going to be buying it as it's dropping. And there's no turning it around because they bought more of it. Period. If we look at the levels that I outlined, this is what classic support and resistance theory or retail-minded traders are going to look at. And some of these lines are going to line up with that logic, but not all of them. And I'm going to contrast what they see and what I'm looking at and when they anticipate something and what I anticipate from an algorithmic standpoint. Changing the state of delivery here, return now starts the delivery lower. Your mindset should be, okay, we're going to keep going down and attacking lows. Every low is a target. Classic support and resistance theorists will say, okay, we have this low here, price trades down. Look at that. Perfect. A floor broken becomes a ceiling. You hear it all the time, and it gets on my nerves. Breaks lower. We have this low here. It breaks below it. Floor broken becomes a ceiling. Well, we can't reach that high apparently, and it just keeps on going lower. We have a low here. Price trades through it. Comes up, bounces a little bit, must have been some support. Oh, it broke it here. Then look what happens. Man, it comes right back up to that level. Perfect. That's a floor broken, become a ceiling. Price drops lower. This low over here, small little consolidation, and then runs back down. Does it ever come back up to it? Nope. Now, there's going to be many times people want this type of environment to happen. And this right here. Sometimes it happens. Sometimes. Look, folks, they sell books all the time. They still sell books. Everybody's coming out with support and resistance books still to this day. And it's been around forever. It doesn't mean simply because you can go and find it in hindsight, it's going to work like that in the future all the time. That's subjective. What I'm teaching you is not subjective. It's time and price. Watch what happens when we change the narrative here. We're going to zoom in a little bit. These are the same levels here, but now watch. We have the original consolidation here. I already keyed up on what you're anticipating to see now. This is a market maker sell model. Trades up into the level I teach you. Hits it, breaker here. Now, the change in the state of delivery from bullish, now bearish, right there. As soon as that happens, now the algorithm has changed its gears, if you will. It trades back up and resets to now sell side delivery. That's what it's going to target. Where's the algorithm going to look for those price points, those specific discount PD arrays to start reaching towards? It ain't going to go straight line towards it. It's going to just gradually keep going lower, back and forth, but it's going to go to where these lows are. Well, that's these lows that are highlighted here. But I'm not looking at the low for simple support and resistance ideas. I'm looking at the very specific down close candles in those lows, because that's where smart money was buying. From this high here to the left, that's the buy side of the curve of this market maker sell model. Everything from this high to the right is the sell side of the curve. Everything that was buying, like this down close candle here before this run up, that's your breaker. They could be buying here with a run to that level, and that would be a scalp. That's enough. It's over for them. They're out. When the market breaks down below that low, that's where your breaker is, and then you can mitigate that. How about over here? These down close candles, they were buying in here. That's not causing this run up. They're buying in anticipation of the algorithm delivering a run higher, offering them profitability. That's what smart money traders are doing. Smart money traders are not buying and their buying pressure sends price higher. That's not what goes on. That is absolutely not what goes on. Period. I don't care who taught you that. I don't care who wrote those books and how nice the people that were teaching that sounded when they said it. It's not what's going on. Period. This is where they bought. Over here, in this range, I want to see something that is a premium array. What is that? Bearish order block, bearish fair value gap, a bearish breaker. Look what we got here. We have buy side liquidity being ran out, and we have a fair value gap. Hits the breaker, trades down. Comes to the top of that series of down close candles here, comes out of it, bumps the bottom of that up close candle right there. There's your bearish order block right inside of that range over here. I would look at that and sell short right in there. And many of you will be like, why are you entering there? And if you go on my YouTube channel and see me executing on a 1 minute chart, you'll see entries like that. And it's going lower. Then what happens? We go into another area of down closed candles where they were buying right before this big run up. Notice I said that? They were buying before this run up. They didn't buy it up. They didn't cause it to go up. They bought it and waited. Then the delivery happens. Extend that range of down closed candles over here to the left of this candle here. So we're in the sell side of the curve. Look inside that shaded area. So you look inside here for a premium array. Up closed candles, fair value gaps, breakers. There isn't any kind of breaker in there, but we have an up closed candle here and the fair value gap. Market trades up into it, closes the gap, hits the order block, and then sells off. It's also optimal trade entry. Then delivery lower. We're inside the original consolidation. So now anything in here, I didn't want to extend this over because it would have been confusing with all the shaded areas, but you can see that we have institutional order flow entry drill here inside the range that's shaded. So there's a sell there. Institutional order flow entry drill there, and it sells off. Sell side imbalance, buy side inefficiency. Institutional order flow entry drill, hold low, which is mitigation, and sells off and attacks the original consolidation sell side liquidity. How many trades is in there? Several, isn't it? Let's go one step further. If you just look at this area in here where the fair value gap is, and this fair value gap there, that could be your model. That's your trades. Isn't that really in ideal locations? With the premise I'm teaching you here. The change in the state of delivery after it hits a premium array, it's not a bullet. It's a breaker. Okay, and once it takes this low out, the logic changes right here, and now the delivery will start being down. It's not sellers are pushing the market down. No, the market's going to go down. It doesn't matter how many people are selling short. It's going down. Period. You either are on board or getting ran over. But if you sold short in this fair value gap or sold short in this fair value gap inside of the shaded areas, now this is between the shaded area, and that's fine because we have the fair value gap here and this imbalance. So this bumping the bottom end of this breaker here and the fair value gap is what I'm looking at, not just trading it into the fair value gap. It's look at the bodies. It's bumping into that breaker and rebalancing that fair value gap that was left open just above this high. These two locations are your redistribution. That's why they're red. I want you to think about it like that. Where these are accumulation in blue, smart money reversal, low risk sell, redistribution, redistribution, another level of redistribution, and attacking the original consolidation sell side liquidity. Now we're going to take a step out from this and look at it on a 3-minute chart. Here's that original consolidation. Here's where those fair value gaps were on the 1-minute chart. See that? Looks slightly different. Maybe not have noticed it so much in here. You have bearish order block here and sells off, and you don't see the institutional order flow entry drill here on the 3-minute chart, but on the 1-minute chart it's there. So what's happening is when sometimes you watch me on a chart and it's going up like this and you see me selling short right in there, I'm using that 1-minute chart like I just showed you before dropping into the 3-minute chart here. I know some of you are new and this is probably going way over your head and this is way too much. You're like, man, this is not making any sense to me. I would have never seen this. Yeah, you would have never seen it. But this is how you start to see it. I'm taking you into price and I'm teaching you things that I have not taught yet. From here or here, targeting that low or that low or that low is a trade for me. Either one of them. Targeting that, first profit, scaling out. Second, scaling. Third, and then leave such a small little portion on, it's insignificant if it stops me out. That's how I look at it. If we look at it from a 5-minute chart, same reference points. Those fair value gaps on the 1-minute chart, now we're highlighting it on the 5-minute chart. All I did was take it from the 3-minute up to the 5-minute. The breaker You see that clearly. You don't necessarily see the fair value gap here, but it's there. And then the market trades down. You don't see any fair value gap there, but it's there on that 1 minute chart. And then it sells off. That's why sometimes when I used to do entries on baby pips and I used to show the videos there, they would say, oh, you're chasing price. They have no idea what I was doing. And it was never going, above where I was entering. But this is the logic of what was going on behind the scenes. Institutional order flow right here on the lower time frame. Can't even see it on the 5 minute chart. See? 1 minute chart's going to give you depth. Even though it's called noise, if you know what you're looking for, it is absolutely gorgeous. If you know what you're looking for, it is giving you the closest thing you can get to what an interbank trader sees on data feed. It's not exactly, but it's the closest thing you're going to get. The market attacks the original consolidation there, and then really takes off and cascades lower into this sell side liquidity here, and then ultimately trades into that low prior to FOMC run up, and then it returns back up into all of this. Here's a 10 minute chart. Same fair value gaps. The breaker, which you can't see the breaker anymore. Not in the way that you would expect, but you can see it here. So when you look at price like this on a higher time frame, like this is 10 minutes, you can see this as a breaker. So okay, let me go into the 1 minute chart, a 5 minute chart, and slice this up into smaller time frames and see if I can get the details here. And that detail is that fair value gap there, but it does trade up into the breaker that would otherwise not be noticeable here unless you understand the logic behind it all. This fair value gap doesn't even make any sense looking at it from a 10 minute chart, does it? Nope. And that's how I was hiding in plain view on baby pips when I was doing my entries. They had no idea what I was doing. Not any bit. It just looked like chasing price. Nothing of the sort. It's nowhere near chasing price. You're getting in there exactly when interbank traders are getting in. Now, high frequency trading algorithms are throwing orders in right here. They're throwing orders in right there. They're throwing orders in right there. And then attacking here and taking out here and taking out here. Now, I want you to take a look at this entry point up here. Okay, if you were waiting for that buy side imbalance, sell side inefficiency, consequent encroachment on the daily chart of Euro, and we extended it out in time, and we traded up into that level inside of the London Open Kill Zone, hits it right in the heart of it, and then say you sold short right in there, you're getting in there with the smart money reversal. If you were looking at that and then targeting that low, that's how I look at price. This extreme premium is going to be paired with that. That's what IPTA is doing. When it's hitting price up here, and when it starts to change its delivery, and the state of delivery changes, and now it resets here at that breaker, all this delivery and price, it's all aiming for that low right there. Because this was the build up into that premium array. How many pips is that? It's 33 pips. From this area here to that low. So there's one trade. Now count how many trades I gave you, okay? 33 pips. If you entered on this breaker and just took out profits here, that's another 18 pips. Now, again, this is all during one trading day during London Open only. We're not even factoring in New York Open. Okay. Just follow me along. So here's another 18 pips. Entering on that fair value gap down to that low. We're not even targeting here. This is just first profit. Okay. From here to here, first profit, adding one more. So now let's assume that you sold short 10 standard lots here. Then you sold 8 standard lots here. Then you sold 6 standard lots here. On all of them, you're going to take out something on each when it trades to that low. You're going to take something off the 10 lot, the 8 lot, and the 6 lot right here. And you're going to stagger the orders, especially for use that are in the United States like I am. Next one, that's 10 pips on that one. If you were taking a partial from this position here and getting out underneath that low. Now, it's more than this, obviously, but it's 27 pips from here to here. From that fair value gap to that low here is another 19 pips. From this breaker here, and you finally take the portion off below the low ahead of FOMC, that's another 38.5 pips. From this fair value gap here, and taking the final portion off below that low here, is another 30 pips. How many pips is that? How many trades is that? All during London Open. And these yahoos out there talking about, it's a 20 to 1 trade. I got a 200 to 1 trade. Man, I'm destroying that. Because I'm pyramiding all of these types of setups. And I know where I'm getting out at. I know what the algorithm is going to reprice to. That's how I ran up those accounts. I was doing these types of things. That's how I did it. Only when I was going back and forth in the same day, buying and selling, that's enigma. I don't teach that. But just working one side of the narrative, one side bias, this is how it's done. This is how you do it. Now, obviously, this is an oversimplification, and it's going to seem like, wow, it's great, but you're probably thinking, man, I'll never be able to do that. Well, if you think that you're never going to be able to do it, then you're probably right. But if you go through the mentorship and you learn and you practice and you learn the logic of what I'm teaching you, and don't be afraid of these lower time frame charts, because this stuff works on all time frames. But if you are able to do it here on a 1 minute chart, every time frame is the same. It's the same. This is occurring on a daily chart. This is occurring on an hourly chart, a 4-hour chart, a weekly chart, a monthly chart. It's the same stuff, folks. But how many trades did you see there? All inside of the London Open kill zone. I didn't even touch New York. Just this. You can't compete with that, because it is the market. You're selling short when everybody else thinks it's going higher. They're not thinking selling short up here. When retail sees this, it's going to keep going up, only to where it needs to go. Consequent encroachment, the buy side imbalance, sell side inefficiency. It's also a higher time frame, daily optimal trade entry. Remember, on the daily chart, that's what that is right there. It's at a premium array, at a time of day when it creates what? The higher low of the day. What did it do from the midnight time frame? It went up. All of this is a Judas swing. They're fluffing it up. Okay, the algorithm is saying, look how good this is. This is so good. You should be willing to pay a higher price than it's reasonable. Retail would love that, and they buy it up all the time. There. Then you wait. Now, you may not have the courage to go right in here and sell that as it hits it. I just taught you how to wait. You wait for the breaker to form. When the change of state of delivery happens and it goes back to the breaker, then that's the reset. The algorithm changes, now starts targeting sell side. And you know how to find sell side. It's easy. But retail traders aren't up here thinking, let's start looking for the lows to be taken out. They're not thinking that. They're not thinking that at all. They're either buying it up here or watching it drop, saying, man, I wish I would have sold it up there. And you've done that too, just like I did in the 90s too, because you don't know these things, but now you're learning. Add up all those pips, folks, and do a hypothetical. If you would have did one standard lot here, okay, $10 per pip. Then you did 8 minis here, then 6 minis here, and that's it, nothing more. You're pyramiding, but you're building new additions to your original entry, but with less lots. And then figure out everything I just did with the pips and how much money that would be on a hypothetical basis. And you also determine how many are you going to take off below that low. So in other words, if you sold a standard lot up here, which is 10 minis, and you sold 8 minis here, and then you sold 6 minis here, how many are you taking off below this low of each, and how many are you taking below this low of each, and how many are you taking off here? And did you leave anything on for New York to continue? And where did you get out over here? Because this is a level, and you got to go back to the higher time frame to see it. But that's how I look at price. When I see price running up, I'm calculating the same way that the algorithm is doing, because I know what it's going to reach for its information. And it's not highly sophisticated. Every swing low, that's sell side liquidity. Old lows, sell side liquidity. Why is it useful? Why is it important? Why do I even label it sell side? Because the context is, if we're up here and we're going down, smart money has sold short. How do you get out of a short? You have to buy it back. That means somebody's got to be willing to sell it to you at a cheaper price. Well, you got to look below the old lows, because that's where the sell stops are. They have no choice but to sell to you when it trades there. That's why the algorithm goes there. And that's why they go there quickly. Because they don't want the traders to have their minds changed about, maybe I shouldn't have that stop there and let me get out of that trade. Now it's starting to make sense. So anyway, that's going to be it for this weekend. I hope you've learned something from this. And obviously, when you break down the marketplace and setups, do this exercise here. Okay. And you're going to see how many trades, how many ways you could have managed it. And when you backtest, do it like this, because you're going to see the infinite level of opportunity that exists every single week. You can frame all kinds of setups. And that's why I tell you, it's interesting for me as a mentor to be teaching this to you, because you all are going to do something uniquely different. Not every one of you are going to sell short up here. A lot of you will sell short there. Not many of you will sell there. Not many of you will take a lot of it off here. Many of you will take it off there. Some of you will hold for that, and others will try to get down there and take no partials. And it's intriguing for me to see that. And you all have your own unique makeup and psyche that aligns with that framework, but you're all trading the same thing I taught you. And to me, it's fascinating. So with that, enjoy the rest of your weekend, and I will touch base with you on Monday.